You are sitting on a risk committee at a large bank. It is a Tuesday morning. There are 11 items on the agenda, and you are on item 7. What that item turns out to be is a small country. You would struggle to find it on a map, and nobody in the room has ever been there. Here is what is in front of you. Serving that country earns this bank about $4 million a year. Real money, not to a bank this size. Now the second number, and this is the one that decides it. If a single customer, 3 steps down a chain you cannot see, turns out to be moving money for someone you would never knowingly serve, the fine starts in the hundreds of millions. And your bank's name is in the headline. So you ask the compliance team the only question that matters. How much checking is enough? And they tell you the truth. Nobody will say. Not the regulator, not the lawyers. There is no line anywhere that somebody signs off on that says, do this much and you are safe. Sit with that for a second, because it is the whole file. You are not being asked to weigh $4 million against a fine. You are being asked to weigh $4 million against a number. Nobody will tell you. So you vote to exit, and so does everyone else in the room. And you are right. That is the uncomfortable part of this file, and it does not get less uncomfortable later. Because 11,000 kilometers away, a nurse who has sent money home every month for 11 years is about to find that it costs more and takes 8 days instead of 2. She will never know why, and neither will you. Nobody sanctioned anybody. Nobody decided anything. 11 items on a Tuesday agenda, and item 7 took 4 minutes. This file is about a choke point that clears about $2 trillion a day, and about how it gets narrower every year without a single person choosing to narrow it. This is the RISE Index, where we follow the routes that goods, energy, and power actually travel, and ask what happens at the narrow. Every file this season has found a bottleneck, a canal, a strait, a repair fleet, a chemical process, a port that counts other people's food as its own. Every one of those you could photograph. This one you cannot. It has no physical existence whatsoever, and it is the largest of them by an enormous margin. 3 numbers frame it. 1. In 2025, a single private clearing system in the United States settled an average of just over $2 trillion per day, $2,014 billion every business day. 2. That system handles roughly 95% of cross-border dollar payment transactions. 3. And this is the number the other 2 exist to make strange. The network of banking relationships that lets a bank in a small country reach that system has contracted by about 25% since 2011. The pipe is getting bigger. The number of places you can connect to it is getting smaller. And the 2 facts are related in a way that is not at all obvious. Before anything else, a technical correction, because almost every popular explanation of this subject gets it wrong, and getting it wrong makes the rest impossible to follow. You have heard of SWIFT. It is usually described as the system that moves money between countries, and as the thing a country gets cut off from. SWIFT does not move money. SWIFT is a messaging network. It carries instructions, a standardized, secure, extremely reliable way for one bank to tell another bank what it wants done. Think of it as the postal service for payment orders. Losing access to it is genuinely serious, in the way losing your phone line is serious, but the money never traveled through the phone line. The money moves somewhere else, and it moves through 2 systems in the United States. Fedwire, operated by the Federal Reserve, which settles payments one at a time, in real time, with finality. And CHIPS, which is privately operated, which nets payments against each other through the day and settles the difference. That is the one handling around 95% of cross-border dollar transactions and about $2 trillion a day. So there are two separate things, the instruction and the settlement. Most coverage collapses them, and once collapsed, the actual mechanism disappears. Because the interesting question was never whether a country can send a message. It is whether any bank is willing to hold an account for them at the other end. And that difference is not academic. A country that loses SWIFT access has lost its telephone. A country that loses its correspondent has lost the only address anyone could send money to. The first is loud, immediate, and gets reported. The second is a letter with 30 days notice, and it is almost never a story. So here is the mechanism, and it is much older and much more mundane than the politics around it. A bank in a small country cannot hold dollars directly. It has no account at the Federal Reserve, and it is not a member of the American clearing systems. So it does what banks have done for over a century. It opens an account at a larger bank that does have that access. That larger bank is called a correspondent. When a business in that small country pays a supplier, in Germany, the local bank instructs its correspondent. The correspondent moves the dollars inside the American system, and a chain of accounts settles the difference, which sounds like a solved problem, and was one for about 90 years. Then something changed in the arithmetic of holding those accounts, and it changed everywhere at once. The whole of international finance rests on that arrangement, not on a treaty, on banks holding accounts for each other. And it is genuinely old. In May of 1917, the Federal Reserve signed its first reciprocal account agreement with a foreign central bank, the Bank of England, accounts on each other's books, in each other's currencies. That is the seed of the entire structure. Two institutions agreeing to hold money for each other for convenience. Today, there are more than 200 account holders at the Federal Reserve Bank of New York, maintaining over 550 deposit and custody accounts. Read that number again, because it is doing something quiet. 200 account holders, not 200 countries choosing an American system. 200 institutions that each, at some point over 100 years, found it more convenient to keep dollars where dollars settle. And notice what is not in that story. Nobody designed this to create leverage. It accreted from an accounting convenience over a century because it was useful, which is worth pausing on because it cuts against the way this subject is normally framed. There is no founding decision to point at. No moment where a room full of people agreed that the world's payments would route through one city. There is a sequence of individually sensible arrangements, each one making the next one more sensible, running from 1917 to this morning, which makes what happened next much harder to explain and much harder to fix. Somewhere around 2011, the number of correspondent relationships in the world started falling, and it has not stopped. A study by the Bank for International Settlements found active relationships down about 20% between 2012 and 20. More recent figures put the decline at roughly 25% between 2011 and 2020. No policy caused that. No country was expelled. Banks simply stopped renewing. And the reasons they give, when asked, are almost boring. The cost of knowing your customer went up. Anti-money laundering obligations expanded, and correctly so, because the money laundering was real. But here is the part that does the damage, and it is the single most important sentence in this file. Banks report that the problem is not the cost of compliance itself. It is the uncertainty about how far compliance has to go to avoid a penalty. So, go back to that Tuesday morning. You are in the room again, and now you know the mechanism you did not know then. Look down the table. The bank across town is holding the same meeting about the same country this quarter. So is the one after that. None of you can see each other's agenda. And here is what none of you can see from inside your own room. When you exit, your customers do not disappear. They move to whoever is left. Which means the bank across town wakes up on Wednesday, holding more of the country your committee just decided was too risky to hold. So their concentration goes up. Their risk committee flags it, and their vote gets easier than yours was. You did not push them. You just left, and leaving was the push. Run that 4 times, and a country is down to 1 bank. Run it once more, and it is down to none. And notice the asymmetry, because it is the whole engine. If you stay and nothing goes wrong, nobody in this room gets promoted. If you stay and something goes wrong, careers end. And every single one of those decisions is correct. That is the shape this season keeps finding. In rare earths, no country wanted to host the waste. In cable repair, no operator wanted to fund the standby ship. Here, no bank wants to carry the liability for a market that generates almost no revenue. Nobody is behaving badly. The aggregate outcome is still a country losing its connection to the world. So let us name it, because it is the concept this file exists to hand over. The last relationship. Infrastructure that looks abundantly redundant in aggregate can be a single point of failure locally. A network with thousands of links can still leave a specific place hanging by exactly 1. And that is not hypothetical. In parts of the Pacific, some jurisdictions have been reduced to a single correspondent banking relationship. 1 bank. If that bank exits, and it might, for reasons entirely unrelated to that country, the jurisdiction is effectively severed from the global financial system. Not sanctioned, not blacklisted, just unreachable, because the last institution willing to hold the account decided the account was not worth holding. And who that lands on is very specific, and it is not who most people would guess. De-risking falls hardest on small island developing states, on post-conflict economies, and on regions that depend on remittances. That last category matters more than the others, so hold it for a moment. Remittances are money sent home by people working abroad. It is often the single largest inbound flow for a small economy, larger than aid and larger than foreign investment. And it moves in small amounts, from individuals, across exactly the kind of banking relationship being withdrawn. So now go back to the nurse, because you have met her already. She was in the room with you on Tuesday, and neither of you knew it. She works in a wealthy country. She has sent money home every month for 11 years to a family on an island several thousand kilometers away. The amount is not large. It pays for school fees, a roof repair, and her mother's medicine. 1 month, it costs noticeably more because her bank now routes the payment through 2 intermediaries instead of. The month after that, the transfer takes 8 days instead of 2. Nothing about her changed. Nothing about her family changed. Nothing about her country's banking supervision changed. Item 7 changed. 4 minutes on a Tuesday in a city she has never visited. And multiply her by several 100,000 people in one small economy, and you are describing a measurable share of that country's national income becoming more expensive to receive. That is the last relationship, collected from a specific person. And you were on the committee. And the countries carrying it have said so at the highest level. In September of 2022, the Prime Minister of Barbados testified before the United States House Financial Services Committee about this exact issue. Not about sanctions, about being quietly dropped. So why does this persist when everybody involved can see it? Because there is no party whose job it is to fix it, and each candidate has a reasonable objection. The bank says it cannot be asked to accept unbounded legal exposure for a marginal customer. That is fair. The regulator says it cannot promise in advance that any given level of diligence will be treated as sufficient, because that promise would be a loophole. Also fair. The affected country says it has strengthened its own supervision considerably and is being penalized for its size rather than its conduct. Frequently true. And there is no international body with the authority to compel a private bank to open an account. So the network keeps thinning at the edges, one notice letter at a time, while the pipe in the middle gets bigger every year. There have been attempts, industry utilities, to share the cost of due diligence, guidance clarifying what regulators actually expect. Regional payment arrangements, that route around the problem for some flows. None of them have reversed the trend line, and the honest reason is that none of them address the thing the banks say is the actual problem, which is not cost, but uncertainty about liability. $2 trillion a day, moving through a system that is increasingly hard to reach if you are small. Those two sentences describe the same infrastructure. So, what is the actual choke point? 3 figures answer it. 1. About $2 trillion a day through one privately operated clearing system, handling roughly 95% of cross-border dollar payments. 2. A structure that began with a single accounting agreement between 2 central banks in 1917, and that nobody has ever redesigned. 3. A 25% decline in the relationships that provide access to it, with some jurisdictions down to 1. The choke point is not the clearing system. The clearing system works, and works extremely well, at a scale that is difficult to hold in your head. The choke point is the last mile, the willingness of one commercial institution to hold an account for another in a place where the revenue is small and the regulatory risk is not. And there is one more thing about it that makes it different from every other file this season, which is that it is the only choke point here that could tighten without anybody in the world noticing for years. And notice the shape of it, because it is the season's shape in its purest form. Nobody chose this. There was no meeting, there is no villain, and there is no switch. There is a system built by accretion over 100 years, a set of rules written for excellent reasons, and thousands of individually correct commercial decisions. And at the end of all that correctness, a country somewhere is down to one bank. 6 files in, and everyone has landed the same way. A canal that lost 40% of its traffic without closing, a strait that cannot be moved, a repair fleet nobody will fund, a chemical process nobody wanted to host, a port that counts other countries' food as its own, and a payment system reached through relationships that are quietly being withdrawn. Not one of those was designed to be a choke point. Every one of them became one by accumulation, while everybody involved behaved sensibly. So what happens when a country has the opposite problem? Not a bottleneck constraining what it can get, but abundance it cannot convert into anything lasting. Next file. A resource so valuable that finding it should settle a country's future, and a 40-year pattern in which finding it correlates with growing more slowly than the neighbors who found nothing. This is the RISE Index. Subscribe and follow where power moves next.